All right, perfect. We are live. Let's see how I get this live on this other page.
Hi, everyone. We're going live here on the Purse Strings Noon Central Facebook Live event. Today, we have Daryl Hickerson. We will be introducing him, and he's going to talk about debt elimination. We all want to do that, eliminate our debt, Daryl, so this is big. And I'm sure you have stats on the amount of debt that we find ourselves in. I know I was just reading a report yesterday that talked about how much debt people are in, and with the impact of COVID, how that's been so stressful on people. And I know you have some creative ways to eliminate debt, pay it down, pay it off. So we're eager to learn about that. I know there's a lot of debt elimination plans out there, some not legit, some more legit. So we want to clarify and talk about that as well. And as everyone knows, Purse Strings was created to provide free online tools and resources so that women have a one-stop shop, one place to go, where they have access to free, not only content resources right on our site at pursestrings.co, but also we offer these Facebook Live type events as well, where we bring in experts to answer questions on all things financial. So we have Daryl here today on debt elimination. We've had realtors on about buying and selling your home or staging your home. We've had attorneys on here, divorce attorneys, family attorneys. We've also had a slew of other ones. I can't remember them all, but we do this every week.
We have a ton.
Yeah.
And whatever topics people are curious about, debt is always the number one question, is how do I solve my debt? It's always the first question, always the highest vote. But there's other financial topics as well that we talk about.
Yep.
But debt is always the big one. So we'll make sure a couple more people jump online here, and then we can get started.
Well, the thing with debt, if you don't have your debt in control, it just stops you from doing so many other things, right? I mean, it stops you from making purchases like buying a home, and it stops you from, moving forward in your life, because you're always kind of behind trying to get ahead of all the debt. And, debt causes a lot of stress in families. It can cause a lot of arguments and unrest, and, we don't want that. We want to make sure that we understand what our debt is. We know what our scores are around debt, and we have a plan in place to pay it off, pay it down, and get in control of debt. So that's a big topic here today. And again, Purse Strings, we don't charge for anything that we do here at Purse Strings. We always provide free online tools and resources. And then also we have a whole big list. It's getting bigger, growing by the day, actually, of financial professionals, what we call our Purse Strings approved providers, of which Daryl is one of them, who will always be there to, help women. Yeah, that's right. Think of money as energy. If you have debt, your energy is operating at a deficit. That's true. But we're always here to offer financial help and assistance. So with that, Maggie, I'll turn it over to you.
Yeah, let me give an intro to Daryl. Daryl Hickerson, after 20 years in the medical profession, noticed that everyday people could not afford, you were a physical therapist, they couldn't afford physical therapy and those services. He became passionate about helping families understand how to plan for the future. One of the key aspects he helps with is debt elimination. When a family gets out of debt, they're able to save money to purchase what they need and can invest in the future. He can help with this and help educate families and Purse Strings friends in different ways they can invest in their future. So with that, Daryl, I'll give you the floor.
All right. Thank you for that introduction. You both hit some great points. Barb, one thing that you mentioned is if you're in debt, you can't do a lot of things. And one thing that people have trouble with is retiring when they have debt. They spend their money that they should be spending on retirement, they spend it on paying off the debt. So they end up paying 19% on credit cards when they could be putting that money away to save 6 to 8% for their future retirement, so they don't have to work their whole life. And I was a physical therapist, and a lot of people couldn't afford their copays. We couldn't treat them because they couldn't afford it. So I became very passionate about relieving their debt. So another thing Barb mentioned is, with COVID, I've been personally at a place with my son. I took my son and nephews to a place in St. Louis. I'm in St. Louis for my son's birthday, and nobody would take cash. Everything had to be on credit. So I had to swipe my credit card to pay for everything. And if people aren't ready to pay that money off, their credit's going to build real high. Plus, people right now during COVID, the pandemic, have lost their jobs or looking for new jobs. It is difficult, and the credit is building. As of 2020, the student loan debt that is federal and private has increased to $1.7 trillion. Out of that, $998 billion of that is from the women. And a lot of that, especially women of color, are carrying that debt. Well, one bad aspect about that is a lot of you know that women do not make as much money as men when they come out of college, so they end up with more debt. That's one of the reasons that they have more debt. There's two other types of debt, is unsecured debt and secured debt. So unsecured debt is credit cards, private loans. Secured debt is, mortgages, HELOC loans, like home equity loans, the car debt. So anything secured to something. So like if you stop paying, they can come and repossess it. They'll take your car away. That's a secured debt. So with that being said, unsecured debt is $911 billion. It was in the trillions recently until the mortgages became low and people started refinancing their houses and taking extra cash out. So that lowered that quite a bit and increased the amount of secured loan. I do not have the numbers for the secured loans at this time, but that has been increasing. So there's also, with that, unsecured debt, 26 to 27 million or $1,000 on average per family that has debt. In America, 1 out of 3 people have debt, and that average is what I just said. So if you're walking down your street, every third house, someone is having a problem with debt or has increased debt. So that's a very high number, and that's where we come in to try to help people. The other places debt comes from is medical debt. People have procedures. I just recently had a total knee replacement in December, and luckily we had really good insurance, and my bill was $40,000, and we only had to pay like $1,200 of that. So, and that was just the surgery itself. That's not the anesthesia, that's not the doctor's visits, that's not the doctor that comes in and sees you for 2 minutes that you don't remember because you're on pain medicine. You get bills for all those things, and it builds up, and it's a leading cause of bankruptcy in America. So it's real important to have good insurance and to help pay for your medical debt, get it paid down. Tax debt is also prevalent in America. $528 million is owed by Americans. Out of those people that owe debt, 16,287 is owed per family. That's a higher number than I expected. And, luckily we do not have tax debt. We're able to pay it off every year as it comes along. So that's a staggering amount of debt. And so people ask, what do you do with that? How do you get rid of the debt? Well, there's 6 basic ways that people can get rid of debt. One is pay more. Like if it's a credit card, pay more than the minimum amount due. So a lot of people just pay the minimum amount and just let it go. They set it on auto pay and they don't pay any more than the minimum amount. That's going to take forever to pay that off. Even if you pay an extra $100 per credit card, that's going to help pay that off a lot sooner. Another way people do, I mentioned earlier, is refinance homes, or they do consolidation loans. So that is taking money out for more like a home equity loan. You take money out to pay off the loans, and you end up with a lower interest rate, but you still have. I'm just looking at my message from my wife there. You still have debt that you have to pay off, and with the home equity loan, it could be a 15-year loan, it could be a 30-year loan. You may lower your interest rate from 19 to 2 to 4, but you still have to pay that off in 30 years. It's still helpful, but it's like putting a Band-Aid on what your loan is. You're just kind of postponing the inevitable. You don't actually pay it off, you just extend it out a little bit. So a third way to get rid of your loan is Chapter 13 or bankruptcy. You're paying off, the lawyers, the court costs, attorney fees. There's a negative impact on your credit score, and it could be 5 years or more that you're having a problem with your credit score. So I usually save bankruptcy for a last resort when you can't handle any other debt. So that's kind of last resort if you need it. Some people do need it. I've had some friends that had it, and now that their time's up, their credit scores are finally improving again, but it did take a while. So another way to pay off your loan is your family bank. A lot of my friends do it this way. And what you do is you invest money into an account. It could be an indexed universal life account, or it could be some other savings account that you can withdraw money from. And you put money in there. And what's nice about the indexed universal life is you're building up life insurance too. So if something did happen and, unfortunately you pass away or you're not there anymore, that life insurance policy will pay off the loan for you or the debt for you, so that your family that you leave behind doesn't have to. So with your family bank, you put money in and you take it out and pay off a loan or pay off the debt as you get money. Then you keep putting money in there, and then the next debt comes due, you pay that off. So this can pay off all your loans. It can pay off your secured loans, unsecured loans, medical debt. And, you can start with the lowest amount due, or you can start with the highest interest rate, just whatever, is best for you.
So Daryl, where would you go to your family bank to make one of these accounts?
So you can do it on your own if you want to, or you can go to an advisor. One of your purse strings credited ladies is Stacy Swanson. She does your family bank, and it's a great way to pay off money, but it does take 7 to 8 years. Depending, it could be more, it could be less, depending on how much debt you have. But what's nice about it, you can pay off your cars, you can pay off your home loans, and all of it's gone in 7 to 8 years. Plus, you have the life insurance policy, and you get used to savings.
So do you pay money up front?
You pay money as you go. So you can just start putting away like $500 a month or whatever you can afford at the time. And then as that bank builds, it's accruing interest as it builds. And then you can just pay off whatever you're going to pay. And then you keep putting money into that account. You still pay your minimum amount due on your bills that you owe. So, you don't have a hit to your credit score that way. And you keep improving, your credit. You increase your savings. You get rid of your debt. So it's a win-win situation, but it does take a little bit of time, and it takes consistency, and it takes, I want to say resilience, but because you have to, I can't think of the right word. You have to be,
you have to keep paying all the money to the bank every month then. And so you have to be, if you're not, you have to make sure you're not spending and making any more debt.
Right. Exactly. We're going to talk about that a little bit later, but your family bank is like yours. You started on your own. So that's why I said you can go see someone about it. For instance, Stacy, she monitors it with the person, helps them do it. And she helps them pay. She keeps them on task, make sure they're doing what they're supposed to. If you do it on your own, you can kind of do the same thing, but you may not be as
Almost accountable.
accountable. Yeah. So she holds you accountable for what you do. So that's what's nice about Your Family Bank. I know a few other people that do it too. One is G Meadows. He's one of our male allies through the Females in Finance Network. So he does the same type of thing.
Okay.
And then there's the debt elimination programs. There's different programs. There's a validation program. There's assumption program. There's settlement programs. So they're all a little different, but they kind of do the same type of thing. Your debt is paid off in 2 to 4 years. There's usually 0% interest. There's no loans. So we're going to talk about that a little bit more in detail after this next category. So the sixth way you can get rid of debt is the Snowball or Avalanche pay down method. Excuse me. And what that does is you take your smallest amount of loan and you pay it off. You keep paying your minimum amount due, and you put money aside into a savings account or some other account, and you pay it off the next way. That works good, except if you have a title loan or payday loans, those can be to 300 to 500% interest. So you want to definitely make sure you pay those off first before the lower loans. And so that's one way to do it. But what I usually work on is the validation and assumption programs. So when you're looking at the different programs, you got to find what's best for you. So if Your Family Bank works good for you, you have the time to pay it off. If you need that debt paid off right away, real soon, the debt elimination validation assumption programs may be better for you because they can pay off your debt sooner. So if you're looking to purchase a house and your credit score income ratio is bad, then you're not going to be able to pay or get a house. So what you do is you pay it off sooner with the debt elimination programs, and then you're able to get into the house. You just reapply and you're able to get a new mortgage. But when you are looking to do a debt relief program, whatever program it is, check the Better Business Bureau. You want to make sure they're A+ rated, A rated. Make sure that they don't have any bad reviews. You want to do your own research on the company. You want to investigate it, do Google reviews. Google reviews have been really good lately. When I had my own physical therapy company, it's one thing we push for is like, hey, did you like what we did? Leave a review. We didn't just ask the people that liked us. We asked everybody. We had a sign hanging up. Let us know what we're doing right. Let us know what we're doing wrong. And I had 5 stars as a physical therapist. So when you searched physical therapy in the city I was in, I came up first on the Google reviews because I had 5 stars. And so that's what I hope to do with this program too. So what other things you want to do is you want to look at how much the program will cost you. So different programs will cost a certain amount of money. Your Family Bank doesn't cost anything. It's just money you're putting into the bank. Some of the validation or assumption programs has a small minimal fee. The settlement program cannot have an upfront fee, but it will take a fee out of your settlement that's negotiated. So that's one thing to keep in mind. You want to know how long they've been in business. Is it a company that just started 2 years ago? I don't know about them. So National Debt, I think, is rated number 1 in the country for debt elimination, debt relief. But I talked to them recently, and they may be number 1, but their payback program was still pretty good, but their interest was a little higher than some other programs that I know out there. So you want to know what kind of debt they take. So some people take the unsecured. Some people take the secured. A lot of people don't take the secured. They'll take private student loans, but not federal student loans. Federal student loans is a different topic, different type of loan. So right now they're in forbearance until September 30th. So a lot of people don't want to do anything with their loans, but you do want to try to get rid of that as soon as you can too. And there are programs out there for different people. Just, if you have questions about that, I can help with that also. But like I said, that's a different topic for now. How will this affect your credit score? You want to ask that because some of the debt programs will tell you not to pay your minimum amount due on your credit cards, your statements, your loans, whatever. Don't pay your minimum. And then what happens is that ends up hurting your credit score. But as you progress, it's just a temporary decline in your credit score. As the programs progress and you pay off some of your loans, your credit score starts to raise. And at the end of your credit, your credit score is usually higher than when you entered the program. It's better than what it is. Your loans are all paid off. Some of the programs you do not have to enter all your debt. You can choose some to enroll. You can choose some not to enroll. Some people obsess over their credit scores, and a lot of people are having declining credit scores anyway because their debt to income ratio is declining. So eventually they won't be able to get a mortgage or other credit cards because their credit score is so bad. So if it's still high, it's going to end up being low. So you might as well, if it is still a decent number, you might as well still enroll in the program sooner to get your credit score back up faster. So keep that in mind with your credit scores. And the credit score is really just a number so you can get more debt. So keep that in mind. When you're applying for something, do you really need it? Do you need another credit card? Do you need more debt? The important part is to get out of debt, not accumulate more debt. So that's what your credit score is for. So if you're worried about your credit score, a debt enrollment program is not for you. If you're like close to 800, you're like, should I get rid of this debt? If it lowers your credit score, some people do it because they won't do it because they don't want to ruin their credit score. Like I said, it's temporary and it won't be long. It's not like bankruptcy that will mess your credit score up for quite a few years. So I'm not an expert on bankruptcy, but what I do know a lot of is about the validation and assumption programs. So those are typically 2 to 4 year programs. You can get out of debt pretty fast. So, I said earlier, the average American is about $26,000 in debt out of the people that owe debt. So if you enter that program, validation program is working with a group of lawyers, litigation partners. And what they do is they negotiate, or they call the creditors, and they find out if that debt is valid or not. So, they make sure their I's are dotted, the T's are crossed, and make sure that they follow the Fair Credit Reporting Act and all the other laws that were put in place to make sure that the client isn't harassed. So if it is harassed, if it is, not all the I's are dotted, not all the T's are crossed, they find that debt invalid and they just eliminate that debt. And the client just has to pay what they negotiated on. So I said the average debt is 26,000, but I'm going to use a number I can do easily in my head. Say you enrolled $100,000 into the validation program. What you would owe is just $45,000. It's just 45% of what you owe is what you pay. So you owe $100,000, you end up paying $45,000. It's over a 2 to 4 year program, 0% interest. It's, gets you out of debt quickly, fast. There's only $400 upfront fee, and that's just administration fee to get, the paperwork started for the lawyers. And then as they negotiate the terms with the creditors, your credit score ends up improving. So, they get one debt wiped away, then your credit score improves. So you don't necessarily need a credit restoration program with that or anything like that, because that happens automatically on your own, on its own. So that's pretty much the validation program. The assumption program is, let me talk about settlement program first. Sorry, Maggie, I'm skipping around a little bit. So the settlement program is you're paying into an escrow account. And when you get enough money into that escrow account, you end up paying off a loan. And while you're paying into the escrow account, the bank is working on your behalf to negotiate terms with the credit card company. So some credit card companies, able to pay off, at 70% of your debt. Some are able to negotiate, 50%. So I tell people usually it's about 50% of where you want, of what the debt you owe. And a lot of times the settlement program is good for the people that have been in collections. They're close to being garnished. Their wages are being garnished. So that kind of person fits well in the settlement program. You cannot, so if you're looking at a settlement program, they cannot take any fees up front. So you want to make sure that they're not doing that. So back in 2008, when the housing crash happened, a lot of people had settlement programs. They were taking money from people and say, hey, we'll take this loan off your hands and you only pay us this much. Well, they would just take money off people's hands and they wouldn't pay anything. So the settlement program's not in every state yet. It is starting to gain popularity again. There's been laws put in place to keep people from doing that. So that's not in all the states. Our validation program is in all 50 states. And what I'm going to talk about the assumption program next is that's in 48 states. It's not in Maryland and it's not in Oregon. So the assumption program is a little different. What happens is the debt is assumed with the client. So the bank goes into debt with the client and they have a proprietary way that they negotiate terms with the creditors, credit cards, medical debt, and it's similar to negotiating the payoff. And what happens with that is you pay a $250 administration fee, and then it's starting to change. Some companies are different. Some people don't take any money per account. Some people do take money per account. And that's just one of the questions you're going to have to ask is, when I join the program, what am I going to have to pay? What do I owe? The assumption program I'm familiar with, there is a $59 a month fee to be in the program, and it is just a 3-year program. So 0% interest. You enroll in the debt. Credit repair is not included with that. And a lot of times you might have to do a credit repair separately on their own. So what should you do? With that being said, there's a lot of options out there. But keep in mind, if you enter in the assumption, settlement, and validation program, you can't use your credit cards anymore. Cut the cards up, get rid of them. The program's to help you get out of debt. So I'm not a credit counselor, but what I do is I keep track of my client and I say, hey, how are you doing paying your debt? I see you didn't pay it this month, or you're doing good paying it off. Are you doing okay? You didn't apply for any more credit cards. So that's another thing you don't want to do is, apply for credit cards. So some people have like a mileage credit card that they use. They have a business card and they have mileage on it, and they don't want to put that credit card they don't want to enroll that into the program. So a lot of times I'll say, do you have another credit card? Oh yeah, I have this one I don't even use. It's zero balance. I don't even use it. So what I recommend is putting money, transferring the money from the credit card that you want to keep onto one that you don't use, and then enroll that credit card into the program. That way you're not losing your mileage, you're not losing your benefits. Personally, if I had to enroll in a program, I wouldn't put my Costco card in there or my Amazon card. I don't want to lose my Amazon money. I buy something on Amazon almost every day. So, I don't want to lose those. So I would have to transfer that balance, if there is a balance, onto something else to pay off. So just keep that in mind when you're looking for a program too. But a lot of times people can do more than one option. So if they have debt they want to enroll, and some of the programs, there's guidelines that they have to meet. So the validation program, there is no minimum that they take, but they don't recommend enrolling less than $8,000. If you enroll less than $8,000, the program is usually not a benefit to you. So keep that in mind. With validation, you want to do at least $8,000. There is a $500 minimum per account that you enroll. And the assumption programs, there's $15,000 minimum that you can enroll, up to $350,000. Validation program and settlement program, there's usually no maximum on how much you can enroll. The settlement program, the company I'm familiar with, is $8,000 minimum. Some other companies may be different. So, and they all take unsecured loans. The validation program is actually a little different. You can take more options than unsecured loans. So some of the options would be if you have a timeshare vacation rental that you're not using anymore. You're still stuck with the mortgage payment on that. You don't know what to do with it. They'll actually take that in the validation program. And judges do not like what they do to the consumer. They do not like the interest rate and the what they make the consumer pay. So a lot of times they throw that out. Validation program I'm familiar with, they have a 90% success rate in getting rid of the debt and proving it is invalid. So that is a very high rating. They've been doing it for years, very good at it. Another thing, I said you can't take mortgages, but if your house is foreclosed and you still owe money on it, you do not live in the house anymore, you are able to enter that into the validation program as well. So stuff like that. If you have questions whether, will I take this debt? That's when you talk to someone like me. We're able to help you decide what is involved, what you can enroll in the debt, what you can enroll in the debt. So we're here to help. And what I usually recommend for people is when they enroll into the program, say they do the debt validation program, they have $40,000 in debt, they enroll into the program, it gets cut down to about $17,000 to $18,000. So when that happens, that usually decreases the minimum amount due also during the month. So a lot of times it saves them about 50% on their monthly payment. So what do you do with that extra money? A couple things I tell people to do. You can save that money. You can invest that money. You can pay off little loans that you didn't, or little debts that you didn't include in that. But what the goal is to be debt free by the time you retire. When you retire, it's kind of late to start saving for retirement when it's the retirement age. So you want your debt paid off first, so you can start saving to go into retirement. So a lot of times there's options. You can enroll into a program. You can do your family bank. So you're learning to save. You get the life insurance policy. You keep saving after your debt's paid off. You're in the habit of saving already. And that's what a lot of people don't understand is it's a life change. You have the money, instead of paying debt off, you keep that same money and you apply it to something else so you don't have to pay debt. So if you enroll into whichever program it is, you finish the program and you've been putting money into a savings account at the same time, then you don't have to rely on credit anymore when you're out of the program. So you're not in debt anymore. Your financial fitness is improved. You've learned to save. You don't have those credit cards that you had before. You're not dependent on the credit cards anymore. Hopefully you have learned to only purchase what you need to purchase something on a credit card that's emergency and then immediately pay it off. So there are credit counselors. If you cannot do that on your own, there are people out there that can help you do that. And, I can help you find someone like that. I work with quite a few people that help with the credit counseling as well. I help people a little bit, you need to pay this, you need to pay that, but counseling is not my job. There are other people out there that do that, and they're helpful for that. So personally, my favorite is doing the debt elimination program. You get your debt paid off 2 to 4 years, saving money. If you haven't been able to buy life insurance yet, I recommend buying some kind of life insurance policy. And like your family bank, I usually recommend, for the life insurance policies, an index universal life. That way you're putting money in, you can take money out as you need to, end up with a account full of money, hopefully, if you saved correctly at the end, and your death benefit improves. You can also, if you're more risky, you can, there's variable universal life. There's the stock market. If you're risky, you put money in there. But if you've been in debt, I don't necessarily recommend the stock market. I recommend getting your portfolio built up and then investing in something a little more risky. So fixed index annuities are another good way to invest money. They're not as volatile as the stock market, not as volatile as a variable, and it's safer. So a lot of people like that safe ability to save. Some people still like the volatility of the variable account. So that's kind of depends on your risk assessment there.
Daryl, that's been a ton of great information.
Yeah, I think I'm about there.
It really seems like, everybody really has to sit down and assess their own situation. It's not just one direct answer and this is how you pay debt. It's, you really have to assess a lot of the moving parts, which I think you really explained here today.
So a lot of one thing I didn't mention is don't be afraid to ask questions. You have to ask the company questions, especially if they say, hey, we got this contract you need to sign. Read the contract. Make sure, you read the small print, because some contracts are, you pay it off early, and they may have you, if you pay it off early, you may have to pay off the rest of it as income, like what was forgiven. You may have to make sure they're not going to claim that to the IRS as income. So you can end up with a $40,000 tax bill at the end, and you didn't even realize it, or they report $40,000 to the taxes. So you want to make sure that's not in there, and that can happen with federal student loan forgiveness or buyback programs. So you have to be careful with that. Make sure you ask questions. Like I said, speak with a credit counselor. And a couple of important things, like I mentioned, is cut up your credit cards.
Yep.
Learn how to do credit, and then make a budget. If you don't know how to make a budget, you can Google it. You can talk to a credit counselor, like I said. I do a budget, and
we offer our free course has a whole thing about how to make a budget, and it has a worksheet to help you do the Snowball method if that's something you're interested in trying.
So that's one thing I recommend is do the debt program, do the Snowball, pay off those little loans that couldn't go into the program, then you end up debt free. And then when you get all the things you paid off you want to, get into the habit of saving. That's very important too, is that habit of saving, putting money away. If it's you only have $5 that month, put that $5 away. It does. And I always made fun of my friend growing up we were in high school, and he'd go to the bank, and we worked at Six Flags, an amusement park here, and we didn't get paid much, but we'd go to. He's like, "Hold on, I gotta go to the bank." I'm like, "Okay." So we drove to the bank, and he put $5 in the bank. I'm like, $5? I'm like, "Why are you just putting $5 in the bank?" Well, I'm putting it in savings, and he
knew what's up
for himself, and he's saved that extra, $5 his whole life or whatever he has. And disciplined is the word I was looking for before. He's very disciplined in saving money, and I wish I was that disciplined. So
I saw this meme the other day that was like, every time I said it was just only $5, I probably spent $10,000, which is,
right.
I mean, the same thing, except you spent it. It's a little backwards, but yeah. So I think this has been great information. We got to stop. We got to fix our problems, and then we got to learn how to move forward in a good direction, so we don't end up there again.
Definitely.
Hey, Daryl, that was great information. I have a couple questions. So when they're in these debt elimination programs and they make payments, who do they pay exactly? Do they pay to the person, like the company that's paid down the debt elimination?
Yeah. So they do stop paying their monthly payments to their creditors, and they pay the debt elimination program. So the debt elimination program says, okay, your $100,000, we're going to decrease it to $45,000. You're going to owe X amount of money, say it's $500 a month until the program's until the money's paid off. So up front, they tell you how much it's going to be, how much you're going to owe, how long it's going to be. The validation and settlement programs, they're a little more flexible on where you can pay. So like the validation program's $250 minimum payment. So if it takes 4 years to pay that off, with the $250, that's what it takes. But if you can afford, I'm making up a number now, if you can afford $500 a month, that time gets decreased to like 3.5 years or whatever. So they look at how much you can afford at the time. And if you're already paying $1,000 in debt, you end up paying like $500 a month. So it saves you $500. So you can end up doing whatever you want with that $500. Like I recommend paying off smaller debts that you couldn't enroll, or investing that into the future.
Right.
Not getting more debt, not buying the car.
Right.
Mustang you always wanted. You don't want to.
Yeah. It's all about human behavior, right? I mean, sometimes people, when their debt's paid off, it's a little scary because they feel like they're debt free, and it gives them a clean slate to create more debt. Because they always think, oh, I can pay this off this time, right? But if you can't pay for it in cash today, you can't pay for it tomorrow. So it's really about human behavior and like your friend who was making those deposits, even though it was $5, he was strengthening that muscle about continuously making a deposit every time he got paid, which is what we should all do. So I really like that story. Yeah. It's great.
I wish I would have.
Yeah. Well, we all got to learn at some point, right? Whether we like it or not. Yeah. So this has been great information, and I'm so glad that you're here today to share these programs with us. Yeah.
Of course. So thank you again, Daryl Hickerson from United Financial Network. You can always reach out to Daryl at daryl@unitedfinancialnetwork.com. He is also one of our wonderful Purse Strings approved providers, so he can be found on the Purse Strings website as well. So thank you again, Daryl, for being on here today, and we'll talk to you soon.
Dr. Barb, I appreciate it. It was wonderful talking to you guys.
Yep, and we will talk to you again soon.
All right. Thank you.
Bye.
Thank you. Bye, everyone.